Hi, welcome to EQSIS Financial Services, and we always appreciate your interest in learning stock trading and analysis. And for next few minutes, we're gonna study about the basics of technical analysis. Okay, before this, we already covered the basics of analysis, wherein we studied about fundamental versus technical. And we know that the fundamental is very powerful, but still we're gonna follow technicals. It's only because the input is accessible only when it comes to technicals, because when it comes to fundamental analysis, the qualitative factors are not available to everybody and very difficult to get it. As far as the input of technicals are concerned, it is price and volume. The traded price is available to everybody almost instantly in real time basis, and number of shares traded is again the market information is accessible to anybody. So using which we're gonna do analysis, but we have to see whether how this actually works. So we have to study things in detail. We generally recommend people to trade with knowledge and discipline simply because we believe that if you follow those two, and you will be on right side, and your chances of making money is quite high, using knowledge and discipline. Okay, what is technical analysis? Technical analysis actually studies the market, demand and supply. So we actually study the market and we try to determine the demand and supply. Okay, and if you manage to identify the demand and supply, it is very easy for anybody to comment about the price movement. If the demand are greater than supply, then we expect the price to go up, and if the demand is less than the supply, then probably the price may come down. So the point here is to identify demand and supply. The input given to you is price, traded price and volume, using which we have to identify it. It's quite possible to identify. We have a lot of theories which we're going to study in the follow-up videos, which can give you the confidence to identify the demand and supplies. And forecasting and understanding. Okay, when it comes to technical analysis, we are studying the market action. It means someone is already doing trade and we are watching whether it is on the buying side or selling side, and then we are taking a deal. It means we can never forecast the stock price. We can always spend more time with respect to understanding the price movement. So the more the time you spend to understand the price, the chances are there to make money for you in the near term. Okay. A lot of people think market discounts everything. Is the assumption made by the technical analyst. For us, it is not just about assumption, it is a fact, or even I can say it is my belief. It is a fact that the market discounts everything. How? If anything goes wrong in any particular company, and you are inside the company and you are already aware about the news, generally as a human nature, we tend to react differently by that particular point of time. If you are a rational man, probably you try to make this as a deal, and you go to the stock market and you try to sell whatever the shares you have. That will create supply in market, and this is actually prohibited as per SEBI norms, comes under insider trading. Okay, then you are not doing it as per the norms, but still the probably people might watch you because you are a key person inside the company. So generally people watch because you about both your physical and your activities, everything. And if you give any clue to the people knowingly or unknowingly that there's something weakening in that about the company, before coming to the news, it goes to the market because someone else is go to the market and selling it. That will reflect in terms of supply. So I'm sure that the market will discount everything as soon as possible, even in terms of natural calamities. It cannot discount before happening, but I'm sure it will discount the moment it happens. But I'm sure it discount before it reflects in the news even. Okay, what is the input? It is very simple, because price and volume in real time basis, it is accessible to anybody, and it is very powerful and transparent. Just because it is powerful and transparent, we are following technical analysis, whereas the input of fundamental analysis is not transparent enough. Okay, what is our working platform? As a technical analyst, what do I need is about charts, because we have a lot of data, a lot of price it is getting traded in a day. Keeping it in a data format is very difficult to visualize it. For a convenience sake, I'm using it as in a charting platform. And we have a different charting platform, a line charts, bar charts, candlesticks. Before studying into this, first we have intraday charts and EOD charts as well. Okay, first we study about line charts. See, this is x-axis and y-axis. This is day 1 price, day 2 price, day 3 price which is flat, day 4 slightly increased, day 5 again goes up, and day 6 it came down. If I connect all the prices using a line, then it become a line chart. Once again, I'm doing the same, but you see so many prices are here, but I'm not getting the information about what is happening on this particular day, which is day 1. Whether this day is positive or negative, I don't know. I'm sure this day is positive from yesterday, but what exactly happened in today's trading is missing. Whether today's stock is opened slightly above or slightly lower, that I don't know. So I probably need more information about the day. So what I do is, this is a day it opened and it closed here. Stock opened here, traveled between this range, which is the high and low. This is the high it made, this is the low it made, and stock closed here. Next day stock opened here, which is much lower, and traveled to this extent and closed here. Opened here, traveled here, closed here. It means this gives you more information about the charts. This is nothing but a bar chart. So why do people need bar charts? Because you get detailed information about the days. And we have interesting charting platform which most of the people gonna use it, which is called candlesticks. The source is from Japanese people. Look at this. Again, this is a bar chart. I hope you people can now say it is positive because it opened here and closed here. It slightly increased. So this is bullish. Again, this is also bullish. It is a bar chart. Kindly watch the construction of candlesticks. Now I make this as a box. I'll sketch it like this. It become a box. Now I'll delete the part which is in between. Now this become a candlesticks. Once again, I'll explain you how we're gonna do it. But this time I gonna fill it with color. If I make it empty, this shows positive. If I make it empty, this shows positive. If I fill it with dark colors, then it become negative. Okay, so probably the first candle is actually bullish candle, the second candle is a bearish candle. Again, it has open, high, low, close. There is no extra information from bar chart, but still it is visible better when compared to the bar charts. So we are using bar charts and candlesticks to get detailed information. We are using candlesticks to get a better graphical appearance. So that's the use of three different. When you have about more number of data points, it is better you go with line charts, because by the time bar charts and candlesticks may not serve the purpose. But when you see things in detail, when you focus on one particular area, then it is better we can go for a candlesticks. Okay, what is intraday charts? Every 5 minutes if I put a dot, it become intraday charts. Every 15 minutes, anything less than a day, it become intraday charts. For every day, if I put a dot, then it become a daily charts. Every week, it become a weekly charts. It can be monthly, yearly, but we generally recommend people to follow a daily charts. Okay, now we have seen the aspects of as a trader perspective. Now we have various theories which comes under the technical analysis, helps us to understand the price movement. The first one is Dow theory, which is the olden concept. It's very old, but we consider still it is a golden concept because it is the first ever theory. The first ever effort has been made by a person is none other than the Charles H. Dow in order to identify the demand and supply. So we use this theory to understand the remaining analysis. Although it is old, but still it is valid. But people have a lot of critique about this analysis. We're going to study this analysis in detail in our upcoming videos. As far as the price patterns is concerned, the Dow theory will give you the directions. By using Dow theory, you can identify that the direction is positive or negative. You can identify the market trend is positive or negative. But using price patterns, not only the direction, but you can understand the behavior, whether it is, whether you expect the price to go in a faster mode, or will it take it for a long time, it's a steady move, or is it a temporary move, can be answered using a price patterns. If you are a trader who buy and hold the stock for a 1 month, 2 month, 3 month, 4 month, then you sell it later, then you follow Dow theory. It's more than enough. But when you wanted to understand the behavior, when you wanted to incorporate the trading instruments like call options and put options, then you should understand the price movement, price patterns. Candlesticks analysis, it is what something really loved by a lot of traders because it is meant for a weekly traders. If you want to buy candlesticks, if you take a decision based on candlesticks, it's generally powerful when it comes to weekly to a monthly. It is generally powerful when it comes to a short term basis. So if you are a kind of person planning to buy a stock now, holding it for a weeks of time and selling it, then follow the weekly candlesticks analysis. And we have a gap analysis, which is a sign of strength. It means candlesticks, price patterns and Dow theory give you some idea whether the price will go up or down. Gap analysis says where exactly you're located. The price are moving from 10 to 20 to 30 to 40. Are we nearing the maturity stage or still we have a long way to go? That can be answered by gap analysis. Gap analysis give you whether the trend, the current trend is strong or weak. Yes, we are moving. Are we moving with strength, or are we started diminishing our strength, or the strength is coming down? That can be answered using gap analysis. And interestingly, it's man-made things, technical indicators. Like a lot of analysis can be made into an algorithms that will help any layman to easily understand the market. So probably the moving average, relative strength index, lot of analysis. There are thousands of indicators there, but we gonna cover only the moving average and RSI, which probably give you some idea like how the technical indicators works. But these are well taken by the technical analysts across the world, so these are very powerful as well. So probably we're gonna conclude the basics of technical analysis here, and each Dow theory, price patterns, candlesticks, gaps and technical indicators we're gonna study further videos in detail. So probably you can, if you want to see the things in action, watch the series of videos which we're gonna have it near term. Okay, what next now? Now it's time to go towards the Dow theory. After completing this video, it's time you can move and watch the Dow theory video. Check out our new videos here. If you find this video useful, if you learn something about technical analysis here, we request you to share this video in your social network, or kindly refer to other people who are interested. Probably some of your friends must be interested in watching this video. Kindly refer this to your friends. And if you have any viewpoints about technical and fundamental, or anything about the technical analysis, you can actually post your views in the below comment box. And if you want to join us, we always appreciate your interest in joining with us. And thanks. Happy trading.